Howdy. Welcome to the impact of development finance on U.S. foreign policy here at the Bush School, D.C. I'm Raymond Robertson. I'm the director of the Mosbacher Institute for Trade, Economics, and Public Policy, housed mainly in College Station, Texas. But we're really excited to have the opportunity to share this lecture series with you tonight. This is our third of three lecture series on economic diplomacy. And this series has been highlighting the tools of U.S. economic diplomacy that are essential to support U.S. goals both here and around the world, including foreign assistance, which is our first episode, trade, which is our second one, and then tonight, development finance. Tonight, obviously, we are focusing on development finance and the impact the United States can have by partnering with the private sector to finance solutions to critical development problems and challenges around the world. We have a couple of housekeeping issues for you tonight, just to share with you. First of all, there is going to be a question and answer. Our goal was to model this as much as a classroom setting as we possibly could. So after the presentations of the speakers, there'll be opportunities for you to all come up here specifically into this microphone to ask your questions to either of the speakers or the participants. And keep in mind that if you don't use this microphone, the people online cannot hear you. So it's really critical that you would come up even if you're shy. But I will remind you that the Zoom audience, if you're on Zoom, you can also send in your questions. We have a Google link that was included with the registration that you can use to chat in your questions. And I'm going to be receiving them on my phone. And I'm letting you know that now, because when you see me checking my phone, it's not because I'm bored with the rest of the event, okay? It's literally, I'm trying to keep the participation as broad as possible. For those of you who do want to submit questions either online or especially if you wanted to come up tonight, I'm supposed to remind you that legally you are being recorded. So keep in mind that anything you say can and will be recorded for our purposes. It will be available, the entire event will be available electronically on the Mosbacher Institute's website next week. So we hope you'll check that out. Before we get started, it is an honor for me to recognize a special guest who's Dana Negroponte, who's here with us tonight, who's a global fellow at the Woodrow Wilson Center and an adjunct professor of international relations at GW. She recently wrote a book on the role that Secretary James Baker had at the end of the Cold War. So I want to thank you very much for joining us again. It's great to see you. We're also really excited tonight. This is the third of the three series, and we've been leading up to this in a number of ways, because tonight's speaker is none other than Robert Mosbacher Jr., who is not here to present in person, unfortunately, because just like our last speaker, he came down with COVID just before the event. So he's in COVID quarantine as well. Apparently, I thought it was over, but we're not quite out of the woods yet. But we're really, really grateful to him that he was still able to participate remotely and will be joining us. For like probably the two of you who don't know Rob, Robert Mosbacher Jr. is the chairman of the Mosbacher Energy Company, which is a family-owned energy company headquartered in Houston. And he served as the 9th president and CEO of the Overseas Private Investment Corporation, which is OPIC. You're going to be hearing a lot of acronyms tonight, but OPIC from 2005 to 2009. And that's an independent agency of the United States government that has facilitated over $25 billion in investments in developing countries around the world. Rob played an instrumental role in drafting and passage of what became known as the BUILD Act, which was a bipartisan piece of legislation that passed in 2018 that combined OPIC with the Development Credit Authority of USAID into a new U.S. International Development Finance Corporation, which we'll be referring to tonight as the DFC. The DFC has new powers that were previously lacking from OPIC that enabled it to compete much more effectively against other international development finance corporations, which we'll be referring to as DFCs, just so you know, and multilateral development banks, which we're referring to as MDBs, and other superpower economic development players, and specifically China. So we're hoping that you've been thinking a little bit about China and that you'll bring some of those questions into the discussion later tonight. But he is now serving as chair of the Development Advisory Council of the DFC. He also serves as the co-chairman of the Consensus for Development Reform, the CDR, a platform for leading conservative and private sector voices in support of strengthening U.S. global leadership through reforming and improving our approach to global development. And I will say that as the current director of the Mosbacher Institute, it has been one of the best parts of my entire career to have the chance to work as closely as I have with Rob, who's been absolutely wonderfully supportive and definitely a highlight and makes me really love every day that I have at the Bush School. So I want to thank you very much for that. And now turn it over to Rob Mosbacher. Thank you.
Well, Raymond, thank you very much for a very generous introduction. And let me say that it's been a great treat for those of us involved in the Mosbacher Institute to have you as its head. So it really is not just a treat, but an honor. So, and I apologize for not being there in person. I hope there's no cause-effect relationship between COVID and giving these talks. And I apologize to those of you both there physically as well as those online. But I am absolutely delighted that Nancy Lee has agreed to come in and be part of our last in the series of talks on economic diplomacy. Nancy, I want to just fill you in a little bit on her background. Nancy's a senior policy fellow at the Center for Global Development, a senior advisor at the Center for Strategic and International Studies. Her work at CGD has been on multilateral development banks, development finance institutions, working on blended finance, mobilizing private capital, and sovereign debt restructuring. So she is very knowledgeable about these subjects. I regard her as one of the experts on these subjects in Washington. So I'm thrilled she's here. And in addition to what she is doing today, years ago, she was deputy CEO of the Millennium Challenge Corporation. She was the general manager or CEO of the Inter-American Development Bank's Multilateral Investment Fund, which was their private sector investment arm. She was at the Treasury Department as a deputy assistant secretary for the Western Hemisphere and for Europe and Eurasia. And she co-chaired the G20 SME Finance Group and was a Treasury negotiator in the Uruguay round of trade negotiations, which connects her to Carla Hills. I also want to thank Mark Green for his excellent presentation on foreign aid and how it is used to fight poverty without creating long-term dependence. I want to thank Carla as well for her superb explanation of U.S. and global trade policy, starting with NAFTA up until the present time, and how critically important it is to have agreements that attempt to establish rules, processes, and structures for engaging in the international exchange of goods and services. Our plan this evening is to discuss development finance. We want to describe the role it plays in complementing and extending our aid and trade policies and promoting entrepreneurial capitalism and the free market, rule of law approach to economic growth and development. Foreign aid, U.S. trade with the world, and development finance all advance American foreign policy interests and strengthen our nation's security. For decades after World War II, the vast majority of capital flowing into the developing world was from governments or public sector institutions. In the last 20 years, the public sector portion of capital flows has shrunk to less than 10%. And the private sector portion now exceeds 90%. Although most of that is foreign direct investment, it also includes remittances, philanthropic investments, and contributions. Let me begin by describing what I mean when talking about development finance. Simply put, development finance is the use of public sector resources to enable and facilitate investment, primarily in middle and lower income countries, in which the financial risks are considered too high for commercial banks or private sector investors to go it alone. The principal providers of such financing are the multilateral development banks, such as the World Bank, Inter-American Development Bank, and the African Development Bank, and a wide variety of development finance institutions, or DFIs. The ultimate mission of both MDBs and DFIs is to reduce global poverty and improve livelihoods through sustainable and inclusive economic growth. Now, my comments are going to focus principally on development finance institutions, and Nancy will speak about multilateral development banks. In the US government, our DFI is the US International Development Finance Corporation, or DFC for short. For the first 45 years of its existence, the DFC was known as the Overseas Private Investment Corporation, or OPIC, which I had the privilege of being president. But I have to say, OPIC is probably one of the all-time worst acronyms because it was constantly confused with OPEC. And I, more than one occasion, had individuals who came up to me thinking I was the president of OPEC and asking me what I was going to do about the price of crude oil, which I said, frankly, I wasn't going to do much. But between the MDBs and the DFIs, there's approximately 140 billion in debt and equity investments around the world. While about 80% of that financing goes to sovereign entities, meaning primarily governments, 20% is aimed at supporting private sector investments. Indeed, all the MDBs have private sector arms, such as the International Finance Corporation, or IFC, of the World Bank. Some DFIs have a mix of sovereign and private sector investments, while others focus solely on private sector deals. The US DFC focuses solely on private sector transactions, and that's what I will concentrate on tonight. Now, how does it work? Let me give you 3 examples that I think illustrate pretty clearly what OPIC and now the DFC have done traditionally to support project development. Perhaps the highest percentage of projects that OPIC and the DFC have done are in the financial services sector. Access to credit in the developing world for small and medium-sized businesses is very challenging. And yet, if you're going to try to stimulate economic growth, it will be driven primarily by SMEs, just as it is in this country. Years ago, OPIC embarked on a strategy of increasing access to credit by taking 2/3 of the risk of a loan portfolio and teaming up with local banks to take the third. This has been a very successful approach and has resulted in the growth of literally thousands of SMEs around the world. In the second term of the Bush 43 administration, when I was serving at OPIC, the US policy with respect to Israel and Palestine was the so-called 2-state solution, a situation in which an Israel and a Palestine as independent states would exist side by side and hopefully live peacefully together. Well, we decided to do, one of the problems was that Israel was an economic powerhouse and Palestine, particularly the areas that had been characterized by sort of extremism, the Western areas, were off the map. And so our task was to help inject as much private capital investment into the West Bank as possible. So we developed a $230 million small and medium-sized business lending program. OPIC put in 150 million, and 80 million came from the banks, Palestinian, Arab, and others in the region. And it turned out to be a great success. Not only was the entire facility used up, but then the Palestinians came back to OPIC a few years later and said, we like this program so much, we'll split it 50-50 with you. But that's an example of where financial access or access to credit played a critical role. A second example involves financing critical infrastructure. This is an area where China has been quite aggressive through its Belt and Road Initiative. I'll come back to that in a couple of minutes, but whenever the US or a friend or ally can finance an infrastructure project in a strategically important part of the world, it is generally a good thing. So my second example involves the DFC financing the expansion and modernization of the new seaport in Georgia. This is a port on the Black Sea where a great deal of wheat, grain, and fertilizer is exported to destinations around the world. The DFC helped finance a new marine terminal that could accommodate much larger ships that could carry up to 50,000 tons of cargo. This was a hugely important facility, and given the tensions in that part of the world with respect to Ukraine and Russia, it's playing a critical role. Finally, one more example of an infrastructure investment that fundamentally transforms lives. This one was in Malawi, where roughly 15% of the population has access to reliable electricity and only 10% in rural areas. The DFC is financing a 20 megawatt solar power plant and a 10 megawatt battery energy storage system. This additional electricity will dramatically improve the lives of thousands of Malawians. The tools that OPIC has used for most of its existence were direct loans and loan guarantees, political risk insurance, and the ability to finance private equity funds with senior secured debt. While those tools were adequate for almost 40 years, two major global initiatives dramatically increased the importance of our development finance capability. First, the United Nations adopted the Sustainable Development Goals in 2015, which were aimed at fighting poverty and improving the quality of life for billions of people around the world. Among the goals adopted was an effort to mobilize private capital for investment in low-income countries like never before. The multilateral development banks and the DFIs were to play a critical role in bringing much more private capital to the table, turning billions of dollars in public sector investment into trillions of dollars of private capital investment, and helping close the huge gap between needs and commitments that has been estimated to be in excess of $3 trillion. A second major initiative that dates back to 2013 was the launch of the Belt and Road Initiative by Xi Jinping in China. While it was originally focused on expanding trade and investment with countries that bordered China or were part of Asia or the Asian subcontinent, it quickly spread to Africa and Latin America. The emphasis was on building and financing critical infrastructure, such as airports, power plants, railroads, and seaports. And they were quite aggressive in offering to finance these projects. While the financial terms were often onerous for the host country government, they were usually the only game in town, so many found it difficult to turn them down. China's strategy was not simply to win hearts and minds in the developing world by financing projects that would benefit the host country, but it was also to finance strategic assets that could benefit China by providing access to critical minerals or building ports that could be used by their blue water navy. At one point, China had some or substantial influence over 70 ports in over 35 countries. Much of that activity went largely unchecked by the US government, our allies and friends, but it did create considerable consternation among our national security establishment. The global push to achieve the SDGs, coupled with China's Belt and Road Initiative, prompted many of us to argue that the United States needed to up its game, starting with our development finance agency. OPIC had been using the same basic tools since it was created in 1971. It was in desperate need of being updated and modernized. It lacked certain authorities that virtually every other DFI had. Specifically, it could finance deals, but could not invest equity in them. And yet equity is often essential to helping a lightly capitalized company in a low-income country get off the ground. A second authority that OPIC lacked was the ability to provide technical assistance or small grants to projects that have great merit, but ran out of money before getting to the finish line. A third authority is the right to do deals in local currency rather than always insisting that they be done in dollars. So going back to the example I gave you of the power project in Malawi, you can rest assured that the consumers of that electricity will all be paying their bills in Malawian currency. And the difference between the dollar and Malawian currency is complicated, to say the least. And finally, since its inception, OPIC has always required that an American own at least 25% of any deal it would support. While that's totally understandable, given the fact that we are spending US taxpayers' money, there are projects that have a compelling foreign policy objective in which it is difficult, if not impossible, to find a 25% US owner. I worked for 3 years while I was at OPIC on trying to stand up an SME bank in Afghanistan. Notwithstanding having the support of Hamid Karzai and a variety of Afghan businessmen and women who told me frequently in Dubai that they would be willing to support capitalizing the bank, I could never find the 25% US owner. And as a result, the project never got done. Given the compelling need to strengthen our development finance capability, a group of us started working with members of the House and Senate in 2018 on drafting a bill. We sensed that there was very broad bipartisan support for legislation, so we worked with Freedom Caucus Republican, on the House Foreign Affairs Committee named Ted Yoho, and a distinguished senior Democrat from the committee named Adam Smith. They were our lead sponsors in the House, and we drafted a bill that would provide all the, quote, authorities or powers that OPIC lacked. So the ability to invest equity, to provide small grants or technical assistance, the right to do deals in local currency, and the elimination of the 25% American ownership rule, with preference being given to Americans, but not an absolute requirement, were part of the bill. It merged OPIC with USAID's Global Development Alliance into a new U.S. International Development Finance Corporation, or DFC, and raised the limit on how much money could be committed to projects from $29 billion to $60 billion. The bill garnered broad co-sponsorship and was introduced in the Senate by Bob Corker and Chris Coons. It became known as the BUILD Act, which stood for the better utilization of investment leading to development. I had a lot to do with the legislation. I had absolutely nothing to do with the name. Somebody stayed up late one night to figure that out. In any event, it was passed by the House in late spring of 2018, went to the Senate Foreign Relations Committee where it was voted out in June, and it passed the Senate in October of 2018. Since enactment of the BUILD Act, the DFC has been increasing its staff, integrating and refining its new authorities, and trying to meet the very high expectations that came with the passage of the bill. Nancy is now going to talk to you about the strengths and challenges of the DC, but first she's going to tell you about multilateral development banks. So over to you, Nancy.
Let's see, am I using this or that? Well, you can all hear me.
Yep.
Okay. Well, I'm very happy to be here and particularly happy to follow Rob Mosbacher, one of my favorite people in this whole world of development finance. And as you just heard, one of the most effective people in bringing people together around good ideas. So what I will do is talk a little bit about the role of multilateral development banks, MDBs, their role in the world and the US role. And then I want to return to the Development Finance Corporation and talk about its strengths and weaknesses. And I will see if I can use this clicker. Or someone else have control over the slides? Because I can just say next slide and that would be fine.
Help is on the way.
Help is on the way.
Help is on the way.
I'm assuming these arrows are. As we're fixing the slide presentation, let me just start by saying, perhaps one of the ways to think about this is if you have $1 of development finance, where should the US put it? And so what I want to start with is sort of a set of criteria that the Congress, taxpayers, the executive branch might think about in evaluating what they want to see in a development finance institution. So the first thing you want to see, as Rob described, is that the institution is not only committing its own funds, but it's mobilizing other finance around that, particularly private finance. So you don't want to just look at the volume of finance of the institution itself. You want to look at this mobilization figure. Second, because after all, if you don't want to look at mobilization, you might as well just view it as aid and something which doesn't actually have a catalytic effect on other people's finance. The second thing is you want a strong results framework. You want to be able to actually see what this finance is doing by a variety of measures. Third thing is the institution from the US perspective should be targeting countries and sectors where the finance adds value. In other words, incentivizing the private sector to invest where it might not otherwise invest. And that's partly poor countries where the environment is difficult to mobilize private investment, but it's also maybe strategically important countries to the US foreign policy. The next thing is you want an institution that thinks about systemic impact, building markets, not just individual transactions, which is one of the hardest things for these sorts of institutions. And then the last thing is you want an institution that has the right tools, non-finance tools and finance tools. And as Rob was just describing, in the case of DSC, it needed some new tools to be able to respond to the needs and also have a greater mobilization effect. Okay, I can do it. So let's start with multilateral development banks. Multilateral MDBs have capital from governments, public capital. And the governments are the shareholders, the only shareholders. And the governments are represented on executive boards, which approve the loans of the institutions and other policy decisions. MDBs, as Rob said, lend to both governments and the private sector. They have offices in every area, if it's a regional bank, in every area, in every country of the region, or if it's a global bank like the World Bank, every country in the world. They are financially sustainable. They are banks. And they're generally profitable. The only exceptions are sometimes during global financial crises or regional financial crises that affect their balance sheets. They're big. So I just participated in a panel that reviewed 14 multilateral development banks in various regions. And together they have equity, shareholder equity of $500 billion. And their portfolio, their outstanding portfolio of development loans is 1.4 trillion. So that gives you a sense that these multilateral institutions are far bigger than any bilateral institution that the United States could put together. So there is value to the US of investing in these multilateral institutions. And the 5 billion versus 1.4 trillion tells you a little bit about leverage, but I'm going to come back to that. So that's an important thing to remember about these institutions. Since they're banks, when you put $1 in their capital, you're leveraging multiples of that dollar in loans. The United States is a major shareholder in most of these banks. Its share of the World Bank, the global bank, is 16.67%, which is big enough so that the US has control over any important decision that requires more than 15% of shareholder approval. That's an important threshold. For the Inter-American Development Bank, the share is even bigger. The share of the Inter-American Development Bank is 30%. So we have a lot at stake with these institutions. So what are their strengths? So coming to the leverage questions. They leverage US dollars of capital in 3 ways. First of all, every dollar that the US puts in is multiplied by dollars from other countries, other public shareholders. Second, the capital is leveraged in lending, just as in any bank. And so you can think of the leverage ratio of something like 1 to 4 or 1 to 3. So every dollar of capital leverages roughly $4 of lending. And in addition to that, since these banks earn income over time, they can take that income and put it into the equity, which then further increases the equity, further increases the lending capacity and leverage. So as an example, for the World Bank, $1 of US capital enables $30 in total lending for the institution because of all of those factors. $1 in the African Development Bank enables $70 because the US actually has a smaller share in the African Development Bank, so the leverage is even greater. So, I mean, I think one point that sometimes gets lost with the multilateral development banks is that just as in the case of security institutions like NATO, where the United States does not want to have to bear the burden of all of the security spending, the multilateral banks give us the ability to leverage contributions from others rather than have to supply all of the development finance. And the leverage ratios are very favorable. So these are powerful contributions. So, and what are the strengths of these banks? First of all, they have all the tools that you could need in development finance: loans and guarantees and insurance and equity, as Rob was describing, technical assistance, policy advice, institution building. These banks have all of those tools. They have sort of technocratic credibility. So in some cases, if a country's policies are really the problem, and really what has to happen is that the country has to change its policies and institutions to create a more favorable investment climate, it's often better for an institution that has degrees of political separation from the country to be advising rather than another government. Or to put it simply, many countries would prefer a World Bank technical advisor telling them how to change their policy rather than somebody from the US government. These institutions can engage with both public and private sectors, as Rob was saying. They're a big source of climate finance, the largest in the world, the largest multilateral source, 63 billion in 2022. They are on the ground in all of these countries. They have strong environmental and social standards. And in many cases, they actually set the standards in countries and across institutions. And they have a lot of accumulated knowledge, policy expertise, and have cross-country learning. Okay, having said all of that, what are their weaknesses? They're banks. So there's a good side to that because of leverage, but there's also a bad side because they are risk averse. And it is a culture that pervades particularly the private finance parts of these banks. They essentially want to engage on the same sorts of financial projects as commercial banks because their business model is really to lend and to fund themselves through the spread between the rate at which they lend and the rate at which they borrow. They borrow at very low rates because they're highly related institutions, and they want commercially viable returns on those investments. So much of the time, there is a little bit of tension between what these banks do and what private banks want to do. And you will hear from private banks the criticism that the MDBs are really actually taking up lending space that they want to take. We saw during the pandemic that middle-income countries, emerging markets, don't necessarily want to go back to the MDBs to borrow anymore. They didn't even during the depths of the pandemic. So it's not entirely clear that given the choice between going to markets and issuing more debt or going to the MDBs, that these countries will go to the MDBs. So there's a demand problem as well as a supply problem. Particularly for private finance, if, as I was saying, the bank is really focused on its own financial interests and in the volume of its own transaction, it can crowd out the private sector. There is a bias in these banks toward lending because they are banks, and so that's what they view as they're most comfortable in that business, particular senior lending. There's a kind of siloed structure in these banks. There's a public sector side and there's a private sector side, and there's sectors and there's countries. Very hard to bring them all together. And in essence, they really didn't deliver on the billions to trillions vision, which was launched in 2015, which was supposed to take a relatively small amount of public finance and catalyze trillions of dollars of infrastructure finance. And that's where, as Rob was saying, China really did much better, at least in terms of scale. So now let's look at the Development Finance Corporation using the same lens, or let's think about what is the comparative advantage of the Development Finance Corporation. So it has a strong mandate from Congress, a bipartisan mandate. That's very rare. It's a very valuable thing for the institution. It has been able to rapidly increase its commitments because of the additional space, as Rob was saying, that Congress gave it in the Build Act. And so its 2021 commitments were actually double the OPIC level. It has a mandate to work in poorer countries. So it is a tool to catalyze private investment in poor countries, which is difficult, but very much needed. It can also finance US strategic priorities. And we can come back to that. How do you sort of square that circle? How can you go simultaneously to poor countries and to maybe middle-income countries, which are we're strategically more focused on? This DFC has really picked up the ball with respect to climate change and has announced a very ambitious net zero emissions commitment. It's been a leader in women's economic empowerment among the development finance institutions. And we did some work at CGD comparing institutions. And so I can say that with some certainty. It has this new authority for equity, which can help it mobilize more finance. And it has a very strong results and impact measurement team. So what are the challenges of DFC? So as I was saying, it's being told to do more of its portfolio in poor countries, but it's also being told you need to be strategically relevant to the United States. So for example, what is, you can imagine DFC investing more in the countries in Central Europe near Ukraine that need investments for dealing with migration or for sort of taking up the slack in value chains, given the destruction in Ukraine. Or you can imagine investments in middle-income countries, digital investments, or investments in vaccines or therapeutics that are in a higher income country, but for the purpose of exporting to poorer countries. So strategic importance can lead you in a different direction than focusing on poor countries. And also there's a tension between DFC's interest in increasing access to energy in poor regions, like sub-Saharan Africa on the one hand, and on the other hand, mitigating climate change. So I'm not saying these things are not resolvable. And in my view, they have to do both of these things and figure out a strategy which puts them together in a way that is understandable and justifiable. But they are pulled in different directions. The staff is too small. It's being asked to do all these things, and the staff hasn't increased that much. And in particular, it needs a lot more staff on equity since that's a new product. Rob knows all about this, but there's a problem with its equity authority, because the way OMB treats equity on the budget is that it is treated the same as if it is a grant. So it is every dollar of investment in equity that a DFC does is the same as a grant. It's as if the money goes out the door and will never come back again. So it's a very expensive budget treatment. It's way outspent by China, and we do some research at CGD which quantifies that. And then it's not on the ground in every country. So it's got to figure out a way to build a pipeline in partnership with others, something which Rob has been working on. Okay, so essentially, let me stop there. I've given you a sense of what you want to see in development finance institutions, why multilaterals are good at some things and not good at others, and what in particular DFC is good at and where it is challenged. Thanks a lot.
Thank you. Thank you very much, Nancy. That was really great. We really appreciate you joining us here tonight in person, but also being such a perfect complement to the remarks that Robin had. I can see why you two get along so well. I think that's great. Obviously, this is a classroom kind of situation. So if there are people here who have questions right away, we'd love to invite you up. I have a couple to start with. What I'd like to do is kind of a three-way question and answer here with Rob. Rob, if I could just start off with you. I mean, Nancy finished up her remarks by focusing on some of the challenges of the DFC. And now that the DFC has been established, what are some of the critical next steps you think it should be taking?
Yeah, well, again, thanks, Nancy. So when we were putting together this broad bipartisan coalition of support, we did not ask those who wanted to support the bill, are you doing this because you think this is a better way to fight poverty? Are you doing this because you think this is a better answer to China? Or are you somewhere in between? And so we have a wide variety of expectations on Capitol Hill, many of which are simply out of sync with reality. And so I think the challenge is the agency has to clearly fulfill its mandate to be a development agency and to take more risk and to head towards more high-risk, low-income countries. But it also is a foreign policy instrument, and it has to be part of how we counter China or we deal with a variety of other investments. So I think these things are all resolvable. I think some among our friends in the NGO community that kind of opted in because of the fighting poverty better, are concerned that the foreign policy deals that the agency does maybe in middle income countries or even upper middle income countries are at the expense of doing deals in low income countries. I don't think that's the case. I think we just need to work our way through that. Just one other comment, and then I'd like to get Nancy in the middle of this, but because the DFC is one institution, even with $60 billion in potential investment capacity, it's so tiny relative to sort of the global challenges we have, and to even countering China on a slightly less ambitious basis. So I believe it's absolutely essential that the DFC team with allied or friendly lenders in geographic areas. So I'd say, for instance, a relationship or a funding partnership between the DFC and the Inter-American Development Bank Invest, which is their private sector arm, could be hugely beneficial for all the reasons that Nancy cited as challenges of the agency. I mean, the IDB Invest has offices in every country. They are much better at garnering and gathering intelligence. They're much better at doing things like local currency issues. And so I think that they would give depth and breadth and more strength and power to the DFC if they team up together. I'll stop there.
Great. Yeah, thank you very much. We have a question that you'd have to come up here to ask the question, if that's okay. Sure. If you could, if you're comfortable introducing yourself, that'd be great.
Hi. My name is Roger Cochetti, and I'm editorial contributor to the Hill newspaper and an author, and had some background in development finance in decades past. But two questions about the DFC. One is, how does it actually coordinate with the MDBs, which I assume are U.S., the focus of U.S. management in them is the Treasury Department, whereas the DFC is the State Department. So you have cross-departmental coordination. How does it coordinate with the other development-related institutions, such as the Agriculture Department and the Peace Corps and whatever else? And secondly, which are, just as an example, which are the top 3 countries by volume of loans that the DFC has provided financing for. Thank you.
Great. Do you want to let Rob take that first and then?
I'll take the first one. I mean,
Sure.
I would say, unfortunately, the coordination is haphazard at best between the DFC and the multilateral development banks. And that's something that we have to change. I mean, it really, it's difficult to convince people in these banks to pay close attention to what someone else wants to do, or to work on a partnership in which is truly a partnership of equals. So it gets talked about a lot, it gets done very little. And I think that's what has to fundamentally change. Now, I think part of what can help change that is what you referenced, Roger, which is Treasury understands that there's a lot that's not being done in the way of access to credit and extension of loans in the developing world. And they are urging these institutions to work much more effectively together and to look at changing their models so they can work together.
From the multilateral development bank side, Nancy, do you have a response to that?
It is the core issue, really, because as I think both of us have said, in order to be able to really expand volume, it's not enough to say, for Congress to say, you have 60 billions of in portfolio authority, you have to have a pipeline of bankable projects. So, and it's very much in the US interest because taxpayer money is going both into the DFC and into the MDBs for that collaboration to happen. And I absolutely agree with Rob. It does not happen on a systematic basis. And I can say that Rob has been trying to bring these institutions together, particularly the Inter-American Development Bank and DFC for, I would say, years now.
Yeah.
So, and it is in their mutual interest. Okay, so it's not a question of, can you build a partnership that makes sense for both? One of the things about DFC is that it is actually not a bank. It doesn't have a credit rating. It doesn't have to achieve a profit target quarterly or every year. All it really needs to do is not lose money over the medium term. So it actually can take more risk than the multilateral development banks. I mean, I've argued that MDBs need to take more risk themselves, but so you can see how they fit together pretty well, especially now that DFC has equity authority. So DFC can really take some of the riskier tranches of these transactions. It can benefit from the MDB presence on the ground and the ability to actually work on these projects. DFC should, in theory, also be able to call on other parts of the US government for grant money to take some risk to actually spend in project development. So that, which would be beneficial to the US agencies like USAID, MCC, because then their grant money gets leveraged in DFC's money and in MDB's money. But that isn't happening. So there's a lot of money or a lot of value that's being left on the table. I mean, I think in very practical terms, what has to happen is that the US government has to find a way to have people in country that can put these transactions together and bring parties together. The MDBs, the grant making agencies, and DFC. That has happened to some degree in the energy sector, and Power Africa has done that, but that's really the answer to building something that can compete with the China model. Because the China model is Chinese show up, they already have the finance. There's no uncertainty about the finance. The finance is there, and then the question is just coming up with the projects to use that finance. We don't have that model. we need some way to build a partnership so that we can scale these transactions.
Mhm.
Yeah, we didn't answer his question on countries. I'm not up to date in where the.
No, I'm sorry.
No, that's all
I
right.
don't
but
know either.
Yeah,
I
I'd
would
say,
imagine that Latin America and Central Europe at the moment are pretty high on the list.
yeah,
As opposed to
Colombia and
Africa,
Brazil.
maybe Asia.
Yeah, Colombia and Brazil and Latin America would probably be the two largest sites for, yeah.
Good evening. I'm Diana Negroponte from Georgetown and the Woodrow Wilson Center. I want to bring up a hypothetical, which is Sri Lanka. Now, if DFC is not a bank, therefore it has greater capacity to take risk. Sri Lanka is obviously now a risky proposition. But you have the example of the Belt and Road, which has invested in there and has got stakes there. How would this combination of the multilaterals, which are banks, and the DFC, which is aid plus, work alongside in a country as high risk as Sri Lanka?
Great.
You want to start, Robert?
Yeah, I'll start. So Diana, good to see you. I would say that both financial institutions, whether it's, the Multilateral Development Bank as a partner, as well as the DFC, have certain strengths. And that I think combining their strengths, particularly their tools. So if you were going into a place like Sri Lanka that has serious, severe financial issues, and you're not in the business of trying to lend them more money like the Chinese or the IMF or someone, then you would look at what is possible from a project finance standpoint, in which both institutions look at what they have to offer to de-risk projects that you see that make sense. De-risk as in provide first loss capacity, targeted guarantees, agreeing to subordinated debt instead of senior debt, bringing in blended finance, meaning perhaps from philanthropic sources. You put all those tools together when you have two institutions that are partnering, and I think you have the capacity to help a country, even one that is as challenged as Sri Lanka is.
And then I would just add to that Sri Lanka is an example of what's wrong with the China model, because a substantial part of that debt, which is now unsustainable, was investments in ports and other things by China. And so you don't want to be investing in things which don't generate the revenues to create the repayment capacity, which is exactly what China has done in a number of cases, including Sri Lanka, but also in sub-Saharan Africa. So one of the reasons that we need a model that works is exactly that China's way of investing essentially doesn't protect a country against investing in unsustainable projects. So then there's the question: how do you ensure that a country is investing in the right kinds of projects that are growth promoting and poverty reducing and revenue generating? So you need a lot of analysis and a lot of money spent on building transactions that really meet that sort of criterion. So that's one of the reasons you need some grant money in the mix, because you need a source of finance to actually work with countries, work with the private, public partners on projects that are actually viable projects and smart, productive projects for the country. That takes time and money. And at the moment, we really don't have a way, with the exception, I would say, of Power Africa, of bringing together the grant money with the DFC money and the MDB money. You need transaction advisors that really, that's their job, is to bring all of these partners together and do it in a fairly timely manner. It can't take 10 years to do this. But we haven't found a way as a government to systematically do that, to have dedicated people at USAID that do that sort of thing, that know how to do that sort of thing, and to give them the resources to do that. And so that's the kind of thing that needs to be scaled. It's not just in the energy sector, in broader infrastructure investment, and that's the sort of thing that would prevent investments that are unsustainable, as in Sri Lanka.
It does sound like a very promising field for some public policy students, perhaps, to go into. Sure. I did see some other hands. Sir, go ahead, please.
I'm Bob Hershey. I'm a consultant. To what extent has the internet been brought into DFC's operations in structuring projects and getting transparency and setting up the criteria so that people can see what's happening?
Rob, do you want to go ahead?
Well, I think obviously the internet's sort of total and complete integration into the operations has dramatically improved the quality of information that's available, particularly on due diligence on projects and so forth. I think of back when I was there, now it's 15 years ago, we bemoaned the fact that we didn't have enough people on the ground in a particular jurisdiction where we were thinking of doing a project. And you still, I think there's probably still no better way of getting information than having people on the ground, but internet access and readily available information, I think, allows the agency to do more work and to do it, and it helps, at least in the short term, overcome the lack of business development presence that the agency has by sharing information among institutions and doing a much better job of being able to measure their impact, again, using in many cases technology.
I'll just add one thing to that, and maybe extend the question a little bit further to what degree should DFC be concentrated on digital investments in the partner countries. And this is an example of where you might want to invest more in an upper middle income country as a way to benefit a broader range of countries. So, it's not hard. And this actually is, this has happened recently. The DFC did an investment in Singapore. And part of the reason, and it was partly done for strategic reasons, partly to encourage US standards, US equipment, US companies, giving them investment opportunities in Singapore, but also it has positive spillover effects to surrounding countries that are not, that have lower incomes, where companies from Singapore then can invest in those neighboring countries. So that's why it's important not to think of investing in upper middle income countries as a diversion from investing in poorer countries. As long as there is a link between that investment and benefits for the neighboring countries, it makes a lot of sense. I just think DFC has to make that rationale clear. And when it decides to invest in an upper middle income country, explain how that's going to have broader benefits for poor countries in the region. And then sort of use that as a criteria. We will invest in upper middle income countries if we can demonstrate that there are poverty reducing effects for neighboring countries.
Mm-hmm. That's critical. Are there other questions from the floor? Because I have a couple of questions, if you don't mind.
Sure.
So one of the things I think that we wanted to do tonight was provide you a platform as well to try and push US policy a little bit forward, right? And Rob gave some specific suggestions in terms of blended finance and so on, ways that we could actually promote this. Do you have some other ideas, or do you agree with what he was saying about how to bring together the multilateral development banks and the DFC to leverage private capital in these countries while at the same time managing that heightened risk? I mean, what would you think? This is your chance, right, to say, okay, this is what we need to do now and next.
Yeah, I think that is the big challenge, and that's the new model that really has to be developed. And I think the way to do that, it can be pursued in a number of ways, but you have to put some agency in charge of creating that collaborative structure. And at the moment, there is no agency in charge of that. So it could be the White House, which typically has a interagency role. It could be, you can imagine, the Commerce Department, or it could be the Treasury Department as the agency that has governance responsibility over the MDBs, or you could give it to the DFC itself. After all, the DFC has a board on which the Treasury serves, as well as the State Department. So, but there has to be a structure set up where there's a set of people that are accountable for creating these partnerships on the ground in individual countries. You could also do it in country through the embassy, although and have the ambassador in charge of making this happen. My own experience in government is that you can't just do it in the embassy. You have to have a Washington oversight function. But that's very different than what happens now. So there have to be very explicit decisions made. I think this is something that Congress should have a role in. Congress certainly has an interest in its stewardship of U.S. taxpayer money and ensuring that these different places where we're putting money, aid agencies, MDBs, and DFCs work together. I would say one other thing, which is that given everything that's happening now, climate change, the war, food security problems, reversal of progress on poverty, pandemics, the need for development finance is just exploding. And we will very shortly, I'm sure, we as a country would be asked by these multilateral development banks for more capital. There's already sort of a little bit of conversation happening on that. I'm sure that will happen.
And we need a lot of master's students studying this topic, I think, to make it go forward. I want to respect everyone's time. I'd love to stay and chat with you. You're welcome to join us.
Well, let me just finish the point, though. The point is, so the U.S. is a major shareholder. When it's asked for capital, it can ask for certain things as a condition of providing that capital. And one of the things it might ask for is that there be more collaboration between the multilateral development banks and also between multilateral development banks and development finance institutions, including DFC, so that all of this can be scaled, this risk can be shared, the development project can be shared. And that's a reasonable thing to ask for as a condition of the capital increase.
It's wonderfully clear and specific. That's exactly what we were hoping for. So thank you very much. I'd like to thank both Rob and Nancy. Thank you very much for joining us. Please join us in attention that. I'd like to thank our online visitors as well, and hope that you all will join us again for events in the spring that the Mosbacher Institute is having. And for those of you who are here, we have spent money to cater a little reception, so give you incentives, and we hope you'll join us for a little bit to mingle with a little bit of our students. So thank you all very much, and hope you all have a wonderful, safe night. Thank you.
Thank you.